like to welcome you all to our final business at breakfast for 2021. I want to thank the Central West Virginia Society of CPAs for sponsoring this morning's breakfast. And with us this morning we have Ryan Mink. Ryan is the Senior Manager in the Tax and Audit Departments of Settle & Stoniker, PLLC. He's been in public accounting since 2007 and with the firm since 2008. He holds a bachelor degree in accounting as well as a bachelor in business administration and graduated magna cum laude from Lee University in Cleveland, Texas. So, welcome, Lee. Just set up here.
Thank you. My name is Ryan Mink. I'm a CPA with Settle & Stoniker in our Morgantown office. I'm a senior manager there. I do practice in the tax department and the audit department, although mostly it's tax now. And so we're going to be talking about tax. I'm going to give you some high-level tax planning things to think about. Thank you. Today we're going to talk about the infrastructure package that just passed. There's only like 3 tax-related items in there, so it'll be like 1 slide. And then we're going to cover a couple slides on the legislative item that is in the works, that we don't really know what's going to happen yet, but we're going to cover what's in there currently-ish, although they probably changed it since I prepped this, because that's just how Washington works. And then I am going to touch on what I call a crypto primer. It's a passion of mine, and I want to make people aware as much as I can, so we're going to touch on that for a few slides. And then we'll wrap up, let you know a little bit about the firm. So I don't want to start with the firm, I'll end with the firm, let you know who we are and what we do. But again, I'm Morgantown office. I want to start by saying thanks to Harrison County Chamber and thanks to the Society for letting me speak. I'm one of those weirdos that enjoy this type of thing. So I will actually probably talk too much and then we won't get done because that's just how I work. And I just want to tell you everything I know, which is I enjoy it. All right, so we just released a tax planning guide. So if you go to our website, settlecpas.com, or if you want the exact link, it's down below. And Kathy can shoot out these slides after the presentation. You can download our tax planning guide. I put a lot of this information from there. It's just a super condensed version. So instead of reading 20 or 30 pages, you've got it in 40 slides. But that's out there if you want to take a look at it and revisit some of the things we talked about or kind of read it in paragraph form as opposed to bullet point form. So we're going to cover some high-level tax planning. So I'll go ahead and tell you, I had this slide was like, I don't know, there's probably like 80 slides in here. I was talking to somebody the other day, like, Ryan, this is too long. You're not gonna make it. I was like, okay. So I stripped out like 20 slides and put them at the very end. So when you get this, you're gonna scroll past my picture at the end and there's 20 bonus slides at the back, which are things like the tax rate table and stuff that I was gonna tell you about, and then I was like, they can look at this if they really wanna get into some of like the nuances or some of these technical items, they can kind of fall back over there. So if you wanna read more about AMT or the net investment tax or see what your tax table is, all that's at the back, okay? I want to talk about what can I do before the end of the year to help my business or help me plan for the future as we head into next year. So in the world of tax, timing matters, right? So the goal most often is to push income to next year, right? So that reduces the income that's taxable this year, or accelerate deductions into this year. So I want to minimize my tax this year is generally the goal. How do I do that? So that's generally the case unless you expect the tax rate to go up or you expect to be in a higher tax bracket next year. So if this year you did really well, you made $100,000, but next year you expect to make $200,000, you may want to save some of those deductions for next year because you anticipate making more money. Or if you're like, Ryan, I've been watching these tax laws and the administration has decided they're going to raise all the rates next year. Well, you may want to save those deductions for next year because all the rates are going to go up. So there are things like that you have to take into consideration when you're trying to figure out, coming to the end of the year, you're trying to talk to your CPA, you're trying to talk internally about what do we need to do before the end of the year. You generally want to push income forward and bring expenses in, unless you think something different is going to impact the tax situation next year. So those are kind of the planning strategies you need to be having with your CPA or internally is what do we think is going to happen next year and then what do we need to do for the end of the year to help out our tax situation. So some ideas to delay taxable income. One of those is going to be, from a personal perspective, increase your retirement savings. Whether that's making an IRA contribution, whether that's increasing your 401k contribution, 403b contribution, creating a retirement plan if you're self-employed and you don't have a retirement plan, that may be a great option for you, is to set one up and fund it. Certain of the plans have to be done before the end of the year, certain of the plans can be done after the end of the year, but this is a good way to get $13,000 to $58,000 stocked away and written off on your taxes. The other one to think about as an individual is, how can I push income to next year? One of those answers may be talk to your employer about a year-end bonus you may get, or maybe a year-end commission check, or something that you can say, hey, I would love to have that for Christmas, but can you just pay that to me on like January 3rd and just push that forward to next year? I've already hit where I want to be from a tax perspective, and I'd rather have that income next year. If they're cool with that, that may be an option for you. But that's a way to push income forward. Some ways to accelerate your deductions. So mail a check or donation before the end of the year. So if you are charitably inclined, get those deductions in before the end of the year. Now, I will caveat that by saying that standard deduction is really large now, right? So $12,550 for individuals, $25,000-ish for married filing joint. If you don't itemize, it's just going to do you any good. You're going to write that check, and it's not going to matter because you're going to take the standard deduction. But if you have a lot of mortgage interest, if you pay a lot of state and local income taxes, and if you're very charitably inclined, and you're already giving donations, bunch those donations in this year to really make sure you're maximizing that benefit before the end of the year. If you haven't hit the SALT limit, so SALT is state and local income taxes. Currently, state and local income taxes are limited to $10,000 if you're itemizing. If you haven't already hit that limit, the $10,000, you can make some of those payments before the end of the year. Again, that's to kind of maximize your itemized deductions. If you're taking the standard deduction, it's not going to matter. And then pay some tuition before the end of the year. So there are some credits and various things that have to do with tuition. So you pay those before the end of the year, you may be able to maximize some of those credits and deductions. Some other things to think about are above the line deductions. So that's before your AGI is calculated. Traditional IRA contributions, if you're paying student loan interest, HSA contributions, which an HSA is a way to stock away some money for health plans, right? So if you have a high deductible health plan, which it's defined, so if you're interested in this, you want to confirm if your plan works, but if you have a high deductible health plan, you can create an HSA and put contributions into the HSA that are tax deductible. The cool thing with HSAs is they carry over. It's not a use it or lose it thing. You fund an HSA and it rolls till you retire if you want. And you can just build and build and build until you're ready to spend the money on medical expenses. Alimony payments, note that, I think there's a laser on here, before January 1st, 2019. So they changed the Alimony Rules with one of the last big tax packages. And so if it was before January 1st, 2019, that's a deduction. If it's after 12/31 of 18, you don't get to deduct it anymore. Educator, if you're an educator expenses, note that if you're paying money to teach kids, like you're buying supplies and paper towels and different things, you do get a deduction of $250, so make sure you're capturing that. And then if you're having to do some early withdrawals of savings, there's some write-offs for that. I mentioned retirement plans. This is a big one. I have small business owners and taxpayers come in and they're like, how can I save taxes? And this is generally the first thing I say. What's your retirement savings look like? And if they're like, oh, I'm not really doing anything, I'm like, that's your first stop right here. A, you'll be ready when it's time to call it quits because you'll have saved. But B, it's an easy way to get a write-off. Now, what's the catch, Ryan? The catch is it's stuck there, right? So you got to be okay with leaving your money there until you reach 59.5, unless it's a Roth. So, but if you're like, I don't need the money, I want the write-off, I'm okay letting it grow until I retire, this is part of your tax planning strategy, is maximizing your retirement savings. If your employer matches and you're not contributing, you're leaving free money on the table. Right? So if my employer gives me 3% match and I'm not doing anything, I'm leaving their money on the table. I have to contribute 3% to get their 3%. So make sure you're maximizing that. And then note that traditional IRA contributions, they have certain limits. So just be aware that if your income's too high, you may not be able to make an IRA contribution. And then some of these other plans have certain technicalities, especially if you're self-employed. All right, so Roth. Let's talk Roth just for a second. If you're not aware of the difference between a Roth IRA and a traditional IRA, it's all based on when you're taxed, right? So if I make a traditional IRA contribution, I save my taxes now, right? So that's a way to get a write-off. I'm gonna contribute $6,000, I don't pay any taxes on that $6,000. Then it grows, hopefully, let's say to $600,000 because the market's amazing over my lifetime. Then I have to pay taxes on that when I retire. Okay, so traditional is don't pay taxes now, pay taxes later. Roth is pay taxes now, don't pay taxes later, right? So it's the reverse. So if I contribute $6,000 of Roth contributions now, I go ahead and pay my taxes on that $6,000. If that $6,000 grows to $600,000, I don't pay any taxes when I take it out at $600,000. So right there's the beauty in the situation. So if you have the chance to do Roth, yes, you got to bite the tax bullet now. If the market performs really well, which who knows, right? But if the market performs really well over your lifetime and you get ready to retire, you don't pay any taxes on the back end. So just keep that in mind. Some 401k plans offer this. If you yourself own a business and you operate a 401k plan, this is something you can add to your 401k plan as a feature for you and or your employees. But just keep this in mind. There is right now what's called a backdoor Roth contribution. So you make, let's say, a Roth, regular traditional IRA contribution or a non-deductible IRA contribution, because let's say your income's too high, but you still want to get that $6,000. You can do a backdoor Roth and convert that traditional IRA to a Roth. Catch is, this may be going away with the new tax law. It's one of those things they're trying to rein in to keep people from skirting the system, especially people that make a lot of money or have a lot of money. They don't want them to be able to do these backdoor Roths or convert their money inside their 401k plan. They want all their taxes now. So here's some of those limits, just for your reference. I'm not going to cover them all, but like I mentioned, there's a big opportunity here to put away $19,000 to $26,000. Save taxes this year now. And do note, if you or someone you know has reached the required minimum distribution age, which is 72 now, you do have to start taking those again in this year, 2021. So keep that in mind. And if you don't take required minimum distribution, so you or somebody you know hit 72, and they didn't take a required minimum distribution, they may have a penalty up to 50% of the amount that they didn't take. So if you're like, what? I was supposed to take a $100,000 distribution and I didn't? Oh great, well you may be paying $50,000 to the IRS. Right, so 50%, that's hefty. Social Security, I'll leave this slide in here, but this is a little table on when your Social Security may or may not be taxable. So again, if you or somebody you know is getting to that point or you're already starting to draw Social Security, that'll maybe be a useful table to circle back to. All right, investments. So investments, right, so if you buy Apple stock at $1,000 and it grows to $10,000, when you sell it, that $9,000 difference is what's called a capital gain, okay? Short-term capital gain is when you hold it less than a year, which would be amazing if Apple stock grew that much in a year, but let's just say it did, they came out with some new world-changing product and it grew $9,000 in a year. If you sold it within a year, short-term capital gain. So Ryan, what does that mean? That means it's taxed at whatever your rate is, whatever your tax rate is. If you're in a 35% tax bracket, it's taxed 35%. If you're in a 37% tax bracket, it's taxed 37%. If you hold it longer than a year, so maybe it's taken 10 years for Apple to grow that $9,000. Okay, that's a long-term capital gain. That's taxed at, right now it's taxed at preferential rates, which one of the preferential rates is 0, which means it's not taxed. So that's one of the things is if you can hold an investment for a year, you get preferential tax treatment. Now, under the new tax law, we'll talk about it later, that may go away. If you make like over $1 million, that may go away. But for right now, most of us are not going to fall in that boat, and so we're still going to have that preferential treatment. So one of the things to keep in mind, if you have a gain, some of your stock, you had a COVID portfolio that performed really well, and you sold a bunch of it to go ahead and lock those in before the market kind of drops back down. So you have a bunch of gains. Consider going ahead and selling some of those investments that have losses, because what you can do is you can offset those. You have something that performed really well, Procter & Gamble, because everybody's scrambling for toilet paper. So they did really well, and you bought that on the front end because you knew people were going to scramble for toilet paper. But something else didn't perform very well. Sell the one that didn't perform very well and let those two things net to save you some taxes. And then the other thing is if you have been holding for a while and you have something that's worth a lot and you're charitably inclined, consider donating it. When you donate it, if you held it for more than a year, you get the write-off of the value at the time you donate it. So example, I have a client whose parents or grandparents left him an enormous sum of money, right? They invested when they were young in some very big companies like a Procter & Gamble, maybe like an Apple when it first came out, and now he's got this huge portfolio that he inherited. He doesn't want to pay a lot of taxes, and he is very charitably inclined. So he will give hundreds of thousands of dollars of appreciated stock so that he doesn't have to pay any taxes on it. What the vehicle he uses is this, a donor advised fund. Ryan, what is that? So that's like a Vanguard, right? Vanguard has a donor advised fund. What that is they'll take your appreciated stock and they'll essentially hold it for you until you're ready to pick charities to donate it to. But the contribution to this fund is a deduction in the year you make it. So if you're like, Ryan, I do have one of those stocks and I want to go ahead and contribute it to $100,000, great. Set up a donor advised fund, contribute to $100,000. You get that write-off this year when you contribute it. If you don't know who you want to give it to yet, that's fine. You can work with Vanguard over the next 3 or 5 years and have them provide that money to whichever charity you would like over the next 4 or 5 years. But you want that write-off now. So that if you have something that's large or you want to go that route, you want to make some large contributions, but you don't have a specific charity you want to give a ginormous chunk of money to, this may be an option to still be able to keep some control. Now again, you essentially recommend the charities you want them to contribute it to, so they could say no, but more often than not they go with it. But you'll get the write-off and then you can kind of trickle that money out over time. So here's, I mentioned the preferential rate. So if you're over a year, right, if you hold your investment over a year, here's those rates. So if you're married filing joint and your income is $80,000 or less, and you got capital gains, it's 0 rate. Right? So that's out there. Now, this again may change. It's one of those things that's up in the air with the law that hasn't passed. But for now, this is where things sit. So if you want to revert back to this table, it's in there. You can take a look at it and figure out where you may land if you have some stock you want to sell or you have sold. Also note, because I get this question a lot from clients who kind of freak out when they have a bunch of losses. In fact, I had a client this past year, had a snafu with an investment advisor, and they sold at the bottom of the COVID downturn, and they have like $1 million of losses. All right, so we get ready to go to tax time, and they're like, I'm like, hey, you're gonna have to pay some taxes. They're like, what about all these losses? I'm like, you can only deduct $3,000. So if your losses exceed your gains, you're capped at this $3,000 offsetting your normal income, your ordinary income. So he's like, what? I'm like, yeah, like next year you're gonna have to sell some stuff that's made some money, and we'll use these huge losses to offset your gains next year. So thankfully the market's gone back up, and this year he has a ton of gains. So part of our planning strategy is, hey, go ahead and lock in those gains, and let's use that $1 million of capital losses that you had and offset those things so you don't pay any taxes essentially this year on those gains. So this catches people off guard. They sell something at a loss. It may be a company stock that you got as part of an incentive. It may be something you bought in that didn't perform well, and they're like, sweet, I got this $40,000 loss this year. It's going to be amazing. I'm going to save some taxes. And then they, they're using their tax software. They're like, it's only giving me $3,000. What's up? That's why, right there. So you get capped. So just keep that in mind. Don't freak out when it happens. Or if you have some gains, because you want to use those losses, maybe you sell the stuff with the gains to kind of maximize those losses. Underpayment penalties. So the IRS wants their money ratably over the year. And they assume that you make your money ratably over the year, in case you didn't know that. They assume that if you make $100,000, you make $25,000 each quarter. That's their assumption. When in reality, you may make $100,000 in the fourth quarter. They don't care. They thought you made it 25, 25, 25, 25. And they want you to pay your tax that way. So if you don't pay your tax that way, or at least in their eyes, you didn't pay it appropriately, you get hit with these underpayment penalties. Which is, you made $100,000, that was $25,000 the first quarter, you should have owed us taxes on that $25,000. And you're like, no, I got all my money in the fourth quarter. So there's ways you can tell them that. You essentially annualize your income. It's a little bit more complicated of a system, but there's a way to get around it. If you're one of those people who are like, all right, I don't make a ton of money the first 3 quarters, and all my money comes in the fourth quarter or the third and fourth quarter, maybe a good time to talk to a CPA to try to minimize those penalties. They're not huge, but if you're already paying some taxes, another few hundred or $1,500 is like, you just hate to write the check, right, to the government when you could avoid it. But just know, you need to be paying in 90% of your 2021 tax liability or 100% of your 2020 tax liability. If your AGI is over $150,000, you got to pay 110%. This is what they look at to determine if you're underpaid or overpaid. Now, if you're an employee, most of the time you're okay. If you have your withholdings set, you're probably gonna be fine. This becomes an issue when you're self-employed or you have a business, right? Because then you have to pay estimated taxes. And that's where this becomes key. So if you haven't paid estimates, you probably wanna pay them because that'll reduce the penalty when you get to April. If you have paid, you're like, well, I've made extra money, then you probably want to give your CPA and have them maybe bump your estimate for January or go ahead and pay something in. If you missed one and you have a spouse that happens to be an employee somewhere, they can increase their withholdings like a lot. I mean, you can essentially tell them what you want withheld for the employer. And what happens is the IRS doesn't know that you boosted those withholdings the last month of the year. They assume that you paid those withholdings in over the course of the year. So if you're like, oh, that's a way for me to like kind of sneak back and make them think that I paid some stuff in early, that's one of those planning items to consider. And this is the one I just talked about, so annualizing your income. So if you're one of those people that earns a lot in the fourth quarter or earns a lot third quarter, generally that's when it works best. This may be something you want to consider to essentially tell the IRS, I earned 0 Q1, 0 Q2, and then I earned my money. And then it can go, okay, no tax was earned first quarter, no tax was owed second quarter. Now let's start calculating things. All right, so businesses. I'm doing pretty good. Awesome. Employee retention credits. This is a huge one. Hopefully, I'm hoping everybody's aware of this. Really hoping. This is a huge one. And if you are not aware of this, please tell yourself, your friends, your family, everybody you know that has a business. This is huge. Okay. 2020. And be like, Ryan, 2020 is over. Okay, you can still get it. All right, 2020. 2020 employee retention credit. When this first came out, they said, you know what, we got the PPP loan, we got the ERC, you get to pick one or the other. And then they would change their minds and like, no, never mind. We really want people to have money. Doesn't matter if you got PPP, you're eligible for both. Sweet. So now let's go look at things, because if I got a PPP loan at first, I didn't care about this, but now they said I can do double dip, I'm game for this. So what does this mean, Ryan? If you had a 50% drop in a single quarter in 2020 of gross receipts as compared to the prior year, so we're doing 2020 versus 2019, any quarter, 50% drop in gross receipts from one quarter to the last year, which generally we saw that in the second quarter of 2020, because that's when COVID shutdown hit, right? That second or third quarter where everything was closed, that's where we see people check this box. You can get 50% of an employee's wages up to $10,000 back from the government. So $5,000 per employee. They'll send you a check in the mail. Now that's per year. Okay, the other test, so that's a 50% drop in gross receipts, or if you're required to shut down by government mandate. So if you're in one of those businesses that was not deemed essential and they made you close, but you kept paying your employees, you qualify for the period that you were closed. The cool thing about this is if you can qualify for one quarter, they automatically let you qualify for the next quarter. So you can get 2 quarters if you can get 1 quarter. So this is a big one, because if you have several employees or even just a handful, this may get you $10 or $12 or $15,000 back. So I have a client, he has just like a couple people that work part-time for him, but he fit this bill. And so we got him, $8,000 or $9,000 back for this one. So then you're like, okay, Ryan, well, what happened in 2021? So they changed this. So this, 2020, is per year. So $10,000 of wages per year. For 2021, they changed it. They made it better. They said $10,000 per quarter. And not only that, we're going to give you 70% of their wages. So $7,000 per employee per quarter. So that's $21,000 per employee, potentially, of money you can get back. Now, that ends as of September 30th. It's one of those things they passed in the infrastructure package. Well, hopefully, Biden may sign it. He hasn't signed it yet. So, assuming he signs it Monday or whatever, it'll end September 30th. But for 3 quarters of this year, you can grab this. And the test got easier to meet. You're only going to have a 20% drop in a 2020 quarter as compared to 2019, not even 2020. So they said, forget the year that was down for everybody. Let's go back and look at the last normal year. And if you have a 20% drop in gross receipts, you qualify. So take a hard look at this. If you run a business or you have friends or family that run a business and they have employees, they may be leaving money on the table. right here. So that same client I mentioned where we got $8,000 back here, he's gonna get $17,000 back down here. And that's a guy that he could use the money, right? It's gonna help him pay his employees longer, it's gonna help him do some projects or gear up his business or whatever it may be. This is a big one, so please make note of it. And again, it's in these slides, so you can revert back to it. And if you Google it, you can find the stuff. IRS has a nice website on it there. All right, so timing, again, so timing for businesses is similar to how we talked about with individuals, right? So the goal is to push income and grab expenses as best we can, unless you think you're gonna be in a different tax bracket or something. So if you're a cash method taxpayer, you can delay billing. So delay sending people invoices so they don't send you money, right? Because cash basis is, once I get it, I gotta pick it up on my tax return. Once I pay it, I gotta pick it up on my tax return. So if you can delay billing those people so they don't send you money until next year, you won't have to pick it up. You may have earned the money, but if you don't bill them and get it in, you don't have to pick it up. That's your cash basis. Now, that's different for accrual. Accrual method taxpayer says you pick up the income when it's earned, right? Not when it's received. So if you provide some kind of services or if you ship some kind of goods, once you provide those services, you've earned the money. And so you have to pick it up on your tax return. So a way to delay that is just wait till, hey, I know you want me to do X, Y, or Z, can I do that in January? Right? You're still gonna get the money, you're just gonna do the work next year and get it next year. Or if you're shipping them goods, you say, hey, I know you really want this, it's not a Christmas present, so you don't need it by December 24th, can I send it to you in January? And that way you haven't shipped the goods, you haven't earned the money yet. So that's something to consider. Also note bonuses. Bonuses are a big one. So if you want to deduct bonuses, pay them before the end of the year if you're a cash method taxpayer. Again, for cash method, you pick up the expense when you pay it, not when it's owed. For accrual method, you pick it up when it's owed. So the nuance with accrual method is you have to have determined the bonus before the end of the year. So you have to have kind of worked through the calculation, but you don't have to have paid it. You gotta work through, I think we're gonna pay out a bonus of $200,000. We're gonna pay it to him when we're ready, when we file the taxes or something. I feel like the chair's in the way or something.